Okay, in these few minutes, we are going to discuss about corporate governance. This is also one of the key areas that is normally examined by the Institute. So one of the reasons why I've chosen to make sure that we have this topic discussed and shared with you through social media. In case you have any questions arising from this discussion, please do not fail to reach out to me either on mobile or any mode of communication, or even during a class time when we have our sessions, the face-to-face interaction. Corporate governance is one of the emerging areas in business management, and we are also going to be seeing why it is emerging and why many organizations are currently embracing it. It's going to be a bit of a history about corporate governance globally and in Uganda. Then we need to understand what is corporate governance, some of the principles, best practices. Then we have the institute in Uganda, and then some of the principles based on some of the modules. As you will notice, or a corporate governance, from your reading or from your own understanding on a day-to-day running of the business, corporate governance simply refers to how companies are being looked after. How companies are being looked after, how they are being governed, and how they are being managed by the people that are actually managing them. We all know that there is what we call the stewardship role in business management. Basically, we have the company, we have its shareholders, and then we have the directors, or the people who have been appointed to actually manage this company. So the directors are going to be running and controlling these companies on behalf of the shareholders. So the way this is being done, the way this is being managed, the processes, the policies, the laws, and how they are administering and controlling this company is what we will call a corporate governance. So it provides a framework in which the shareholders are actually looking at their business through the board of directors who they are appointed. We do not forget that these directors have an interest in this business, the shareholders have an interest in this business, and therefore other stakeholders. You can think about government, it has an interest in this business. You can think about the tax bodies, they have an interest in this business. You can think about customers, they have an interest in this business. You can think about suppliers, they have an interest in this business. You can think about the financiers, it could be banks, they have an interest in this business. So corporate governance comes into play to make sure that there is a balance between this board of directors that are running the business on behalf of the shareholders, as well as other stakeholders. Take an example of regulated entities. If the corporate governance structure is not good, then the regulators are not going to get the information that they would want to have from these organizations. Basic example, we have the banks, the insurance companies, and no wonder these are really at the forefront of making sure that they implement the best corporate governance practices when they are actually running their operations. Like any other countries, Uganda is also going through the process just to make sure that corporate governance is well implemented in our locally established businesses. And of course, that is through regulators. If you look at the Insurance Regulatory Authority, they are currently even engaging consultants to do a review of corporate governance in their players, so the insurance companies and the brokers. Then we also have Bank of Uganda. It is really trying to implement this in the financial institutions that it looks after. The Capital Management Authority is making sure that this comes through in all these public listed companies. So basically, they've come up with guidelines to make sure that at least there are minimum standards for companies that are listed. That's for CMA to have in place the minimum standards that you should have with respect to corporate governance, because we all know that the listed companies are one of the companies that have got to be keen with whatever they are doing, because everybody has an interest in these companies. And some of the things they've put as minimum requirements by the CMA include like directors having to commit themselves to adopt good corporate governance as part of their obligations. Then compliance with the guidelines and disclosure obligations in the annual report, and of course, in areas of non-compliance, making sure that these are properly disclosed. And if the company is not complying with these guidelines that have been put in place by CMA, it must indicate the reasons why they are actually departing from these guidelines that the CMA has put in place. There are some principles they are talking about, and they're talking about best practices relating to the board of directors. That is going to include things like who should be on the board. In these businesses, we have multiple listed companies. We have examples like BFCU Bank, we have like Stanbic Bank, we have like BAT, we have companies like Umeme, we have companies like KCB, I think it's already listed. We have companies like CIPLA. So there are very many various companies that are actually listed on the Uganda Securities Exchange market. And who can be a board of director for these companies? It's not a matter of just meeting anybody on the street and be like, you can be a director in Umeme. No, there are various considerations, or what CMA is calling best practices, to who can actually be the board of directors. Let me give an example of just an SME. When you are looking for people to make the board of directors, there are things you're going to consider. And one of the most basic things that we always consider, even when they just say, hey, get us 5 directors for company X, you need to have somebody who understands finance. So you have to have a financial expert, a stroke economist. He is going to be able to interpret the annual reports. He's going to be able to analyze the financial statements. He's going to be able to look at things like the macro and microeconomic indicators, so that when they are in a board meeting of 5 people, there is somebody who understands what the finance manager is reporting, and you can critique and you can give guidance to the entire board. You need somebody who has a legal background. We operate in a somehow regulated environment, so you need to have you're going to be dealing with contracts. So you need somebody who understands the legal aspect of things. And then the other thing, you need somebody who understands the business. If I am a financial institution, maybe a bank or my microfinance, you need somebody who has experience in that industry. He is going to be able to give better strategic direction at board level. If you're dealing in the transport and logistics business, you need somebody who has experience or who has very good knowledge in the logistics industry. That way you're going to have proper strategic direction. And then you need somebody who can bring business to you. Business is there to acquire customers. So if you know that if I get Chirumira on my board, he's going to make sure that I get all the deals that are in town, then you need that person on your board. So those are some of the things you might have to think about when you're composing and constituting your board of directors. Then it's also talking about best practices with respect to the position of the chairperson and the chief executive. What should the chairperson for the board do, and what should the CEO do? You realize that in some of the companies, you're not sure who is the CEO, who is the chairperson of the board. So there's a little bit of a mixture. So there are best practices that should be followed when it comes to good corporate governance principles. Then what are the rights of the shareholders? Some directors get onto the board and they actually deny shareholders their rights. Things like rights to appointing external auditors, things like rights to appointing directors, rights to accessing information regarding performance of the business. So what are you supposed to be doing? How often are you going to be reporting to them? Are they going to have shareholders meeting? How are the proceedings going to be conducted? Or is it just a board that is there, making all the decisions, and the shareholders are just kept in the dark of what is happening in their own company? Then best practices on how to conduct general meetings. Trust me, there are very many companies that can't even remember when they last had a general meeting, and they have shareholders. And that's very unfortunate because that is not in line with the good corporate governance principles. Then principles relating to accountability and role of audit committees. That is very key because we have said that in the current business environment, we have a stewardship role to fulfill, whereby management of the business is separate from ownership of the business. So accountability and things to do with audit committees, they actually do become key. And that is why CMA has issued some guidelines that need to be adopted if we are to have good corporate governance practices in these areas. And of course, these apply to all listed companies, but even other companies can actually borrow from what CMA has put in place because they've put themselves together and come up with something to guide the corporate governance in public companies. Then, of course, we've had the ICGU come on board. It was formed in 1998. Believe me or not, it's not yet popular. They are trying to make sure that it becomes popular and people can actually embrace and get membership and ensure that it is evident and visible in Uganda. So the Institute, of course, of Corporate Governance of Uganda has objectives, or they have things. They came in to support and complement the efforts of CMA in as far as promoting corporate governance in Uganda. And of course, the Institute has objectives like training and promotion of commercial probability and effective management with emphasis on transparency and integrity in the business community. Where there is a stewardship role, accountability becomes very key, transparency becomes very key, and integrity becomes very key. That is the only way you can go forward. And the ICGU has come in to make sure that they promote this. Of course, they are not aiming at anything rather than enhancing performance of the boards. Board of directors, even if you're an individual director and senior management, they want to make sure that your performance is enhanced. Do you have the knowledge? Do you have the personal development and professional skills to participate or to be part of this board in order to benefit all the stakeholders of this business to whose board you actually belong? Then, of course, developing codes of best practice for good corporate governance in both sectors, public, private, and even the not-for-profit organization. Then contributing to capacity building in corporations by imparting good management practices. These guys are also doing some bit of training. So there's even corporate governance training that is happening. They are trainers, there are companies that are actually doing it. They're doing this to make sure that performance of people in key management positions, directors and senior managers, actually are trained to make sure that corporate governance is actually promoted in the country. And that is, of course, one of the things that the ICGU is very determined, and it's part of their objectives. Then providing an effective voice for company directors and senior managers of these companies in things that are public in nature, legislation, economic, and social matters. We are directors of Company X, which is publicly accountable, say a listed company, or which company URA has an interest in. Because I pay tax. Let's take an example of MTN. Okay, I am a taxpayer, so the government has interest in me, the tax board has interest in me, and several other stakeholders. So it is only fair enough that their voice is heard. If you want to come up with a particular tax that is going to affect the communication companies, it's very important that you also get to hear from the side of the client. And how are you going to get to hear this? Through the company director. So the ICGU is also determined to making sure that these companies, the company's directors, senior managers, actually, they are heard in things that involve legislation, economic, and social affairs. So just to make sure there's freedom. You're not being forced to do something, but you actually appreciate why something is happening. Let me just take an example of tax. From your principles of tax, one of the principles is that tax should be easy to understand. If I'm a director of company X and I do not understand a particular tax and why I'm paying it, it might be difficult to pay it. So I might start, forging around with the numbers, hiding, not declaring the right amounts. But if I do understand why this tax is being paid and how it's being calculated, probably I'm going to have to comply and pay it very well and be a compliant taxpayer. Okay. And that is already good corporate governance because I am complying, I'm transparent, and I'm declaring what I'm supposed to be declaring. The flip side of it is that if I do not understand, because my voice was not heard, I am a director, so I'll just choose to do what? To do the reverse, which is, of course, contravening the principles of good corporate governance. And of course, the Institute is trying to gain membership. They've contacted very many companies and very many chief executives and very many people who are in directorship roles for both large entities and for small entities, and just to try and make sure that these principles are actually imparted and they get popularity across the board. And there we are having our businesses being managed extremely well. Some of the companies that are really serious to be a board of director for this company, you need to be a member of the ICGU because then they are sure. Just like it is, if you're to be a practicing accountant, you have to be a member of the institute because the institute is the regulator. So even some of these companies are making it a requirement that before you get to be on their board, then you are a member of the ICGU, and then we are sure that you're getting the principles right from the body to which you are subscribing. There are several other reasons why corporate governance has emerged. We had many companies failing, and They were failing because they were not being properly looked after. There were very many corporate scandals. There's been fraud by directors, and once the directors start defrauding the company, we even have examples like Polypec, Maxwell, Enron, WorldCom. So all these, the failure is attributed to the fraud by directors, and of course perpetuating creative accounting, and of course that called for good corporate governance to make sure that the companies are being looked after properly. We cannot have such cases of fraud, directors committing fraud against the company, and things like those that could actually make the company to fail, even when it wouldn't have failed. Then, of course, they need to make sure that there's some form of enforcement to stop company failure, like the ones we just talked about, fraud by directors, and very many other things. Then they raised standard they need to raise standard of corporate reporting. Corporate reporting, we have like financial reporting, that's the most obvious, but there is other forms of corporate reporting depending on the industry in which you are operating. If you go to entities like insurance companies, there are other forms of reporting that are going to be making, like quarterly returns to the regulators, IRA, that's in the insurance sector. Banks report on a daily, on a weekly, on a monthly, on a quarterly. So all that is some bit of reporting requirements that they do have. And we want to improve this quality of this reporting so that we are not reporting on a quarterly basis. We are an insurance company and we are reporting window-dressed financial statements. That is what can lead to failure, because you are reporting the regulator that you're performing well, but at the end of the day, you're not performing well. And even the regulator cannot make the best decisions based on the information that you're providing to them, if this information is going to be window addressed. But then, of course, there's lack of accountability. Even right now, in some of the entities, especially the SMEs in Uganda, there's still lack of accountability. And of course, that is infringing on the shareholders' rights. And as such, we are not having a good stewardship role between these directors, these companies, and the shareholders. Then there's also been a lot of excessive pay to directors. This is still somehow happening in some of the companies. At least you'll come across one or two where there's still excessive pay to the directors, because if anything, they determine their own pay, so they can choose to pay themselves anything. And of course, those are the things that corporate governance is going to come in and try and address. Then there was, of course, some forms of fraud and insider trading in some of the companies that has been evidenced, and some of those can actually be addressed by good corporate governance. There's some model, it's called the OECD, 1999 to 2015. It's called the Cadbury and Organization for Economic Cooperation and Development. They've come up with some principles and some concepts that can be considered under corporate governance. If you're to say that, hey, I'm doing well when it comes to corporate governance, then at least you should be having some of the basic things in place. And we talk about the normal ask is the OECD principles. I've seen it, some questions asking about the OECD principles. When they ask you the principles under the OECD, please do not forget to highlight the items you're going to see below here. Rights and equitable treatment of shareholders. These people have the same rights and they should be treated equally. and they should be allowed to exercise their rights. Effective communication, they're getting the right information, allow them to participate in general meetings. I've also seen shareholders meetings where the shareholders come in and the directors are just covering up everything. And somebody just comes. If it gets like the financial report, they highlight profit, revenue, tax, and it closed. And the shareholder didn't even have a chance to ask, why do we have this kind of revenue? Or why do we have this drop in revenue? Things like those. So they have rights and they should be allowed to exercise them. Interest of other stakeholders, you need to have them recognized. You guys know the different stakeholder groups that have an interest in different companies. We have financial institutions. They provide finance, or we normally call them financiers. We have employees. They have their own interest in the company. We have investors. We have creditors. These guys need to be sure that their debts will be paid. We have local communities. They deserve well living with these companies. If you are in production, do not contaminate the environment in which you operate. Be a responsible corporate citizen. We have customers. They have an interest in this company. Things like continued supply, they need quality, they don't want fake products. We have policymakers, the government, the tax bodies. You've got to declare the right taxes. So organizations should make sure that they focus on all stakeholders. Don't say that I am fulfilling the shareholders' objectives and you forget about other stakeholder groups in your business. Role and responsibilities of the board. These guys need to have sufficient skills to carry out their work. They need to be independent and committed. You should have the right board. I've seen companies with one board of director, and in my head I'm thinking, does this guy have the legal knowledge, the business experience, the finance experience? It just can't be one person. And so even if you go to a home, a man and woman make decisions together. So you can't have one board member deciding for the end. And some of them are even big companies. 20 billion turnover is not pretty small money. But you find they have just one board director. I would think he doesn't have all the sufficient and relevant skills to manage the company. So that's one of the principles that needs to be looked at, or under the OECD, that they feel that this is really very important. Integrity and ethical behavior, that speaks for itself. Integrity, we're talking about being honest and straightforward. If you're honest and straightforward, you're not going to be window dressing numbers, you're not going to be misrepresenting numbers, you're not going to be bringing a lot of issues. If you have bad performance, you have bad performance. Declare it and let the board make an informed decision. The disclosure and transparency, it's very close to integrity, because integrity works hand in hand with the transparency. Let information be clear and known by everybody who needs to know it. If it is financial reporting, make sure that this information is going to the right people. If I'm a listed company, probably they need to go to everybody. But if I'm a private company, maybe they need to end with my shareholders and the other stakeholder groups, depending on what they really need. If there's material concerns about the company, they need to be clear, and people need to get, the stakeholders need to get clear and factual information. That is as per the OECD. There are other principles like fairness. It's more related to rights and equitable treatment of the shareholders. So everybody who has interest, they should be treated fairly. Their rights, their views should be considered. Transparency, we've talked about it. Have the information as transparent, as open as possible. Independence. It's very important, especially to the directors. If directors are not independent, they're not going to make the right decisions. Assuming I'm the one on the bid evaluation committee, I'm a director, and my company is under the bidding companies, I wouldn't be independent when making that decision. Even if my quality is not good, I might be forced to award the bid to my company because I have an interest. And that is why if you're on the board, they try to do those independence checks to make sure that people are not conflicted. Honesty, let's say the truth. Don't mislead shareholders and other stakeholders, like people who misrepresent numbers, people who underdeclare taxes. They are not being honest. Responsibility. People should be accountable for their decisions. And if you make wrong decisions, you should be penalized. There people have been penalized before in some of the public offices. I think like there's somebody who caused the loss to NSSF, and that person has since then been imprisoned. So it is only fair enough that you are responsible for the decisions that you are making, and then we can say that there is good corporate governance. Accountability. You be answerable for any consequences and the actions. If you lead a company into a bad deal, you should be answerable to that. Reputation, maintaining the name. There are risks that come along with affecting the company's repute that maybe it has tried to build over a period of time. So that should be respected. Then judgment. The decisions that people are looking at taking should be knowledgeable decisions, okay? And they should be aimed at enhancing the performance of the company. So that is why we say that the directors should be in position to make good judgment. That is, they should have the right knowledge, the skills to be able to make the right judgment or the right decisions. Then integrity is being straightforward in whatever you are doing. You do not want to have a board, or you do not want to have a situation whereby people are not straightforward in their dealings. Then they are going to lead the company into bad deals, and you're going to end up in trouble. These ones we've talked about, the commonly accepted principles. You'll find that most of them are coming from either the OECD or just the principles of corporate governance. Most of them, integrity, transparency, we've talked about it. Issues involving corporate governance principles. Internal controls and independence of the entities, auditors, oversight and management of risk, oversight of the preparation of the entity's financial statements. Basically, we are looking at issues that corporate governance directly interacts with. If people are misrepresenting financial statements, then that is not good corporate governance. If they are not looking and managing risk well, if they're not implementing internal controls, then they are not instituting good corporate governance. Things to do with compensation of the chief executive officer's salary and other senior executives. That's directly corporate governance. Resources are made available to the directors. That's their pay and compensation. Then we have how people are appointed on the board. We talked about composition of the board. So that's directly related to dividend to corporate governance. Then even dividends, how much money are you paying out to shareholders and how much money are you remaining within the company to run the business. So in Uganda, we have the Institute of Corporate Governance being at the forefront, then the Capital Markets Authority that issued out the regulations, and the Financial Institutions Act, which talks about corporate governance for banks and other issues to do with. And why did we develop these codes? To protect the shareholders' rights, transparency, and accountability. The objectives of corporate governance or the principles are what we are trying to achieve in coming up with some of these codes of corporate governance. Enhance disclosure and compliance, facilitate effective functioning of the board. That's board training, orientation, even composing it to make sure that you have the right board. Efficient legal and regulatory enforcement framework. We have these codes to make sure that we are actually enforcing corporate governance, reducing things like fraud and corruption in these companies, poor performance. How are we doing it? There is poor performance of some boards or in some companies, and thus triggering the government and the institute to come up with some of the codes to look after corporate governance. Then, of course, global investors, they are coming in, and of course, they would want to associate with companies that are actually being well managed. There are foreign investors that would want to come and invest in, and those that are coming, and they always want to invest in those companies that are really doing well in terms of how they are being managed. Then reducing the risk of loss to shareholders and giving ground for separation of power in the corporation, making sure that is the clear cut and the stewardship function is being played well. So there are some guidelines that have been issued to the board of directors, objectives, composition, appointments, and elections of the board. Who can be on the board? Induction, orientation, and training of the directors, chairman, CEO, then composition and need for the audit committee. You can have a board, but maybe do you need an audit committee, and what is going to be their role, and how are they acting to make sure that the performance is actually enhanced. The shareholders, things to do with communication, their meetings, responsibility to employees and their roles, and even CSR for these companies. Of course, the other areas they've talked about is the role of the audit committee, management, employees, regulatory bodies, suppliers, and providers of capital in these organizations. There's the Cadbury report. They also normally ask about it, and they've also issued some guidance on some of the items or some of the subjects with respect to best practice corporate governance. They've talked about the board, talked about the non-executive directors, lead directors, audit committees, internal controls, and interim reports, audit fees, and reporting to regulatory bodies. So these are things that the board is supposed to do. Okay, this is the guidance that the Cadbury report has issued when it comes to non-executive directors. How should they be appointed? And what do they do in light to the entire full board? Then their service contracts, how long should they be, and how should they be remunerated? The audit committee. The audit committee, basically the report is giving some guidance on the audit committee, what they should do. Who should be on the audit committee? Basically the knowledge and codification the LISBO should have, what they should be doing, liaising with internal and external auditors, how often should they look at the financial statements, and what are some of the things they should be looking out, like presentation and appearance, keep accounting policies, and major areas of judgment. Then internal audit aspects, what is it covering, how is it being done, are people having the technical knowledge, and are the issues arising actually being addressed in running this company. Then, of course, reviewing the internal control process, Then risk management, the audit committee should have a role to play when it comes to risk management in this company. So those are the different things that the Cadbury report has actually talked about and the guidance that it has issued in light with good corporate governance. There's the other King 3's code of principles. There's not going to be much really difference from the entire subjects and from the other aspects that we have seen. As you can see, things like alternative dispute resolution, risk-based internal audit, shareholder approval of non-executive directors' remuneration, evaluation of the board and directors' performance, things to do with IT governance, business rescue, and fundamental and effective transactions. Then the OECD principles, they've also talked about 6 chapters, and they've also issued their guidance on a few topics. Most of them are going to really be the same, ensuring the basis for an effective corporate governance framework. For there to be good corporate governance, there has to be a framework. Then it's talking about the rights and equitable treatment of shareholders and key ownership functions. These people, their meetings need to happen, then to be given the right information, and they should be able to participate in these meetings. Then institutional investors, stock markets, and other intermediaries. These investors and stock markets need to make decisions. The intermediaries, we can have like the stock brokers and the advisors, analysts. For them to function well and for them to deliver the right message to these people, they need to have the right information. So the OECD model is giving some guidance on that area. Then the role of stakeholders in corporate governance. The stakeholders basically need to work together to reach mutual agreements. If I'm government and I have an interest in MTN, I should be able to agree with MTN. If I'm the financier, I need to agree with MTN. If I'm MTN, I need to agree with my customers. So no, there shouldn't be any violation of one's rights at the expense of the other. Then, of course, discretion and transparency, we've talked about it a lot. And then, of course, the roles and responsibilities of the board, we've talked about it. Are they transparent? Are they having a proper corporate strategy? Are we compensating them well? And are they overseeing the major aspects of the operation? Accounting and financial reporting, how is that being looked at? Then Surveillance and obviously Act. This is mainly coming from the case of Enron and WorldCom, some of the companies that actually collapsed. And they've highlighted a few things and given a few recommendations. And for them, they feel that management, there needs to be adequate disclosure as to whether management is assessing internal controls and if transactions involving management had principal conflicts of interest of insider trading, they should also be disclosed properly. You realize that if you go to most of the financial statements for banks, they will talk about remuneration for the directors. It's going to be disclosed either in the director's report or somewhere at the end under related party transactions and balances. So that is ensuring that where there is potential, because you expect director's remuneration to be having potential conflict of interest. And that way, by you disclosing it, then anybody can do it, can see. Certification of the annual audited reports, CEO and CFO. This is normally done through the director's report. In Uganda, it is not very popular for the CFO to certify. At least the CFOs, the CEOs always certify. If you go to banks, the first person to put his signature is going to be the CEO or the managing director. So basically, they are confirming that these annual reports that they are issuing, they have been reviewed and they've confirmed that the schedules, notes to the accounts, cash flow statement, P&L, balance sheet, and the director's report, then they do not contain material misstatements. They are a true and fair picture, responsible for ensuring that internal controls are okay. They've disclosed to the auditors and the audit committee all the deficiencies, that the signing officers have indicated to the audit committee the notes to the accounts. If there were any significant changes in internal control, all those have been looked at. And, and in the event that there is misstatements or omissions, these guys will return to the company any bonus based on the compensation which was inflated on account. It's not very common in Uganda, but in some jurisdictions, they actually do it. If your bonus is 2% of the net profit, and maybe the net profit was inflated, and you later realize, then you refund the money. You have to put that disclosure and certify the accounts. In the role of board of directors, there are different people under corporate governance. Say if it is going to happen, and those people have different roles that they play. So the board of directors have those roles. There are things like entrepreneurial leadership of the company, deciding on the formal schedule of matters to be reserved for board decision, company's mission and purpose, appointing the chief executive officer, company's values and standards, making sure they are put in place and they're being followed. Then internal controls, are they being assessed and managed? Having enough human resource in place and meeting regularly to discharge their duties effectively. Executive directors, they have their own roles, and these ones, executive, they run the company or they participate in the company's operations day to day. The non-executive, they are outside. So the executive, those directors who are in the day-to-day management of the company, their contracts should not exceed 3 years. Then they should report on the company system of internal controls. Then they should state in their report and the accounts the business is going concern. And their emoluments should be properly disclosed, because for them they are in this, so they earn salary. That is what it is. You're maybe the CEO, but also on the board. Maybe you're the head of credit, but you're also on the board. So your salary needs to be disclosed properly. And for the non-direct executive directors, they are not involved in the day-to-day running of their business. So they should be independent, and they should bring independent mind and judgments. They should be free from any business with a company. They shouldn't be transacting with the company. They should be being the company based on the time they put in. And they should be appointed for specific periods. It's not an obvious thing. You should be appointed for a particular period and you retire, then we can have fresh minds coming in and looking after the company. Then they should not take part in share option schemes so as to remain independent. If you start participating in share payment options, then you're going to lose your independence because now that you're going to start having shares in this company, and then you're not going to be seen to be independent, but rather a director who has another interest in the what? In the audit committees. They should be composed of both executive and non-executive. Then there's some role that is supposed to be done by the audit committees. We don't appoint them for free, so they have some responsibility that they need to play. And reviewing financial statements is the role of the audit committee. Appointment of the external auditor, remuneration, and looking at their resignation. Working with the internal auditor, their scope, then monitoring the independency and objectivity and effectiveness of the external auditors, that's of the audit committee. Reviewing external auditors' management data and response. Those are the findings from the external auditors. Internal audit investigations, they need to review them. Looking at integrity of the financial statements, then looking at the company's financial control systems, and also reviewing the company's risk management systems. That's all the role of the audit committee. And then the chairman of the board, he has his role to play like leadership to the board, supply, vision, and direction of the company, taking a leading role in determining the composition and structure of the board. The chairman is a very key person. He's the one supposed to make sure that his people, he's having the right people to support him run his role. Then setting the board's agenda, plan, and board meetings, chairing the board meetings, ensuring that the board receives appropriate, accurate, and timely information. Then chairing the AGM for the shareholders, and then ensuring that the views of the shareholders are communicated to the board as a whole. In the shareholders meeting, he might be the only person who is there, so he needs to make sure that these views reach the entire board, which he chairs. So it's like a mediator between the board and then the chief executive officer. Please remember that in these parties, they can ask you the roles of each. They can say, give us the roles of the chief executive officer. I've seen this being asked. They can ask you for the role of the audit committee. So when you're reading, know how to understand these concepts. Chief executive officer is supposed to implement and execute the strategy as established by the board. Remember, the CEO is involved in the day-to-day running of the what? So he's the implementer. Whatever the board is going to decide, he is supposed to make sure that whatever has been decided and agreed is actually put into play. Then accountability to the board, all aspects relating to operations, compliance, and performance. Managing financial and physical resources. The chief executive officer is going to be like the accounting officer operationally, and he's going to be accountable to the board. Effective management team, putting adequate operational, financial, risk, and internal controls in place, monitoring operations, interface between the board and the employees. He's the go-between. What is the board saying? What are the employees saying? And then representing the company to major suppliers, customers, and professional associations. He's at the forefront when it comes to representing the company. Corporation secretary, no, the corporation secretary is always the legal person. Compliance with the company legislation and regulations and keeping board members informed of their legal responsibilities. Then advising the board on corporate governance. Maybe the last bit is accountant in a good corporate governance. We all know that we've been talking about these things, but you realize that the aspects to do with an accountant are featuring in a lot. Things to do with accountability, things to do with financial reporting, things to do with internal controls, things to do with external audit, internal audit. So basically, you are the primary provider of information that is needed to make this possible. So it is very important that the accountant's voice is heard in ensuring that we are implementing the right corporate governance practices. Okay. There's some write-up below which you can go through during your free time, just to enlighten you more about maybe what are rules, what are principles, enforcement, and how basically to get corporate governance are in place. So go through this topic, go through some questions in the past papers. They are available. And if you have any questions, please do not forget to reach out to me. Thank you very much and all the best as you revise.